Welcome back, hunters, to the Daily Hunt. It's Thursday, October 3rd, 2025, and Brooke and I are here to kickstart your day with the latest AI-generated insights from yesterday's market action.
Great to be here, Ethan. And wow, what a haul we have this morning. Our systems crawled through a mountain of data, flagging over 24 different stocks with significant community buzz.
Absolutely. There's a real mix today. We're seeing some familiar tech titans making waves, but also a good number of, shall we say, high-energy speculative opportunities that the crowd is really buzzing about. It's a day of hot candidates, but definitely some very risky ones mixed in. All right, let's jump right into it, starting with a name everyone knows, NVIDIA, ticker NVDA. Our insights are flagging this as a strong contender. We saw posts from users betting their house down payments on NVDA, showing incredible conviction. And honestly, looking at the KPIs, it's easy to see why. Revenue growth is a phenomenal 55.6%, net profit margin over 52%, and return on equity at a staggering 109%. This company is just an engine of profitability in the AI space.
An engine of profitability, I agree, Ethan. But let's pump the brakes on the down payment talk for a second. While those growth figures are indeed stellar, the price-to-earnings ratio is still at 53, and price-to-book is 45. That suggests a lot of future growth is already baked into the current price, which is just shy of its 52-week high. There's also a high debt-to-equity ratio at over 10, which is something to keep an eye on. For a company of this size, those high valuations always introduce risk, even with strong fundamentals.
Fair points, Brooke. But the market momentum is undeniable, and the AI tailwinds are just getting started. For a long-term growth investor, NVDA still looks like a buy.
All right, moving on to another tech giant, Microsoft, ticker MSFT. Our AI tools picked up some chatter about Google potentially entering the PCOS space. But the overwhelming sentiment there was actually dismissive of the threat to Microsoft. Meanwhile, we saw another post with someone going all in, hoping MSFT would fly soon.
Oh, Microsoft, the steady giant. The market commentary really highlighted their entrenched position. People just don't see Google's new OS as a real threat. Plus, the news cycle is buzzing with AI being an unbelievable growth catalyst for Microsoft. Their revenue growth is a solid 18%, net profit margin over 36%, and their market cap is approaching $4 trillion. This isn't just a tech company, it's infrastructure.
Right. Infrastructure that's certainly not going to fly soon like a meme stock. While the fundamentals are incredibly strong, that 36% net profit margin is fantastic. But the sheer size of Microsoft means any rapid, explosive gains become increasingly difficult. A PE of 38, close to its 52-week high, suggests a lot of that AI optimism is already priced in. It's a fundamentally robust company, but for those chasing moonshots, this isn't it.
Agreed. It's not a moonshot, but for sustained, solid growth, MSFT still looks like a buy. Now let's talk about Micron Technology, ticker MU. Our data showed some incredible gains, with one user turning $52,000 into nearly $1 million. Users are praising its resilience and astounding legs when it runs.
Well, astounding legs is certainly a colorful metric, Ethan. And yes, a 1,900% gain is fantastic for that user. But remember, that's on options, which is a whole different ballgame. The stock is near its 52-week high, and revenue growth is a strong 46%, with a healthy 22% net profit margin. The AI memory demand is a huge tailwind.
Exactly. The data is consistent with a company in a booming sector, showing strong financial health and market validation. For us, MU is a buy.
Now for a different kind of buzz, Robinhood, ticker HOOD. We've seen multiple posts celebrating massive gains, 1,000, even 1,700%. Users love the interface, the innovation, and the CEO's vision for tokenized assets.
What a run for Hood, right? People are genuinely excited about its future, comparing it to generational stocks, even eyeing $1,000. Its inclusion in the S&P 500 is a huge validation, and their revenue growth is a robust 45% with a 50% net profit margin. Talk about efficiency.
I hear the excitement, Ethan, but the KPIs paint a picture of extreme speculation. The price-to-earnings ratio is an eye-watering 73, and price-to-book is over 16. That means an enormous amount of future growth is already baked in, with very little margin for error. And let's not overlook that debt-to-equity ratio of over 161. While the user interface might be appealing, the financials show a highly leveraged company trading at a massive premium, very close to its 52-week high. For most investors, this is a stay away.
All right, let's switch gears to something truly futuristic. AST Space Mobile, ticker ASTS. People are breaking out the space waffles and celebrating breaking ATH, all-time highs. They're touting successful direct-to-cell calls and seeing it as having an advantage over even SpaceX.
Wow, space waffles might sound fun, Ethan, but the fundamentals here are anything fluffy. Despite the undeniable technological milestones and the community's extreme bullishness, AST is deeply unprofitable with an EPS of -$2 and no net profit margin. Their debt-to-equity ratio is over 43, indicating heavy reliance on debt for a company still in its early stages. Plus, the price-to-book ratio is over 19, suggesting a valuation almost entirely based on future potential, not current assets or earnings. It's highly speculative and incredibly risky. This is a stay away.
And finally, let's touch on Intel, ticker INTC. We saw passionate arguments about geopolitical advantages, with users saying never bet against the U.S. government in its push for domestic chip manufacturing. Many believe it's set for a massive turnaround, eyeing prices in the hundreds.
This is a classic story stock, Ethan. The geopolitical narrative is compelling, I agree. But when we strip that away and look at the numbers, Intel is struggling. They have an EPS of -$4.95, a negative net profit margin, and negligible revenue growth. Their debt to equity is nearly 48. While the stock has seen a run-up to its 52-week high on this future potential narrative, the current financials just don't support it. The market is betting on a turnaround that isn't reflected in their present profitability or growth. For fundamental investors, this is a stay away.
All right, hunters, let's wrap up with today's candidates for your own deeper analysis. Based on our AI insights and market commentary, here's where we'd point your focus. Investigate as a buy, NVIDIA Corporation, NVDA, Microsoft Corporation, MSFT, and Micron Technology, MU. Investigate as cautious buy, Robinhood Corporation, Hood, and investigate as speculative gamble, AST Space Mobile, ASTS. Disclaimer, we're not financial advisors and always do your own due diligence.
And that's the Daily Hunt for today. Just a friendly reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
That's right. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in. We'll be back tomorrow morning with more fresh insights.
Happy hunting!